1 minute. I sincerely believe that we can all hear me. If you can, just give me that thumbs up again, that I5, so that we can proceed. You can hear me, please? That I5. Okay, thank you so much. All right, so let's proceed quickly. IFRS 16, that's what we are considering tonight. And that is lease accounting. Lease accounting is one of the standard that I will tell you that is very, very easy, very, very cheap. But if you don't know it, you don't know it. Now, IFRS 16 rather, is what repealed what we used to have as IFRS17, lease accounting. IFRS 16 is one of the new standards that was introduced by IFRS, and it is to guide, everything that has to do with lease accounting. When we talk about lease, as it were, it's just as the name sounds. Literally, I'm sure what you know about lease is, usually maybe you have a car, a building, or any property that you want to give to somebody for use for a period of time, and then for maybe certain exchange of consideration, maybe money, maybe anything. That's the literary meaning of lease. And I told us earlier that whenever we are looking at standard, we shall be looking at standard from four main angles. We're looking at it from the definition perspective. We are looking at it, looking at recognitions, that is the criteria. We are looking at the measurement basis, and then we are looking at the presentation and the disclosure. So quickly tonight, let's run through the definition. When we talk about lease, what does it mean by definition? Quickly, let's run through. Lease can simply be defined as a contract or a part of a contract that conveys the right to use an asset, an underlying asset, for a period of time in exchange for what we call our consideration. A lease is a contract or a part of a contract that conveys the right to use an asset, an underlying asset, for a specific period of time in exchange for our consideration. Please, I like my students to always have their writing pad beside them so they can jot down certain things. From this definition, we can bring out three key things. Number one, contracts. Number two, the right to use an underlying asset. And number three, there are four things here. Number three, for a period of time. And number four, in exchange for consideration. Whatever that is outside of this definition will never align with a lease contract. Therefore, understand this, that when we talk about a lease, it is a contract. That contract will always give rise to what we call the right to use an asset for a period of time, and then in exchange for our consideration. So literally what it means is that it is a contract between one that we call the lessor, that is the owner of the property, and the lessee, the one that the property is being leased to, for the use of an underlying asset. Please take note of that. For the use of an underlying asset. The use of an underlying asset. Please take note of that. For a period of time in exchange for our consideration. And so, if we want to give an example now, let's assume I own a property of a building. Me that owns that building, I am known as the lessor. Please, you can write that down so that you can know it. I am known as the lessor. Now, Mavis approached me that I should, allow him to use my building for 5 years. And if I will allow him to use the building for 5 years, he will be giving me 100,000 naira every year. If I agree to give him that building for use, it simply means that number one, we have entered what we call a contract. And that contract is that I will allow Mavis to use my building for a period of 5 years. That is a contract. The underlying asset here is my building. The period of time is the 5 years. And the consideration that I'm exchanging this asset for is known as the consideration. That is the 100,000 that he said he will be paying every month. Now, there is something about lease that you need to understand. And that is the essence and the reasons of why we are looking at this standard tonight. That is the accounting treatment, as it were. You know, under IFRS16, there used to be an accounting for the lessor and accounting for the lessee. But with the advent of IFRS16, we concentrate mainly on accounting for the lessee. Why? Because when a lease contract occurs, something happened that is significant, and that is the fact that the rights that the lessee have over that asset will be foregone. The right that the lessee, the owner of the asset, have over the asset will be foregone. That is, will be given to the lessee. In other words, for those number of years that the asset will be with the lessee, it is the lessee that have the right over that asset for use. In other words, the owner of the property cannot lay right or claim on that asset any longer, except if the contract is cancelled, or if the terms of the contract is finished. That is when the right can return back to the lessor. What we are saying simply is this: in your conceptual framework, when we're discussing, the chapter from chapter 1 to chapter 8, under chapter 3, it talks about the components of financial statement. And under chapter 4, we talks about the elements of financial statement. And we gave definitions to elements of financial statements. And we have 5 basic elements of financial statement, which includes your assets, liability, equity, expense, and income. We gave them specific definition. And under asset, we call an asset the right to use. That is, you have a control over the use of an asset. Is that also, if you can say, remember, you have the right to use the asset to generate future economic benefits. If we must go by that definition, it implies that once a lease contract is established, the lessee can no longer have the right to use that asset. The lessor, the owner of the asset, can no longer have the right to use that asset to generate future economic benefit. Rather, the person that they lease the asset to is the one that now have what we call the right to use the asset to generate future economic benefit. In other words, the lessor will have what we call a lease assets, and then we also have what we call a lease liability. Let me take that again. Because a contract has been signed between the lessor and the lessee, conveying the right to use the underlying asset for a period of time to the lessee for a consideration, it means that the lessee now have the sole right to make use of that asset to generate future economic benefit. I'm just trying to simplify the definition so that if you have the basic understanding of it, no matter what we are looking at, you'll be able to deal with the questions as they unfold. So that is that for that. All that you need to know under this definition is a lease is a contract, or a part of a contract. It conveys the right to use an asset to the lessor. So that contract is always happening between the person that we know as the lessor and the lessee. The lessor is the owner of the property. The lessee is the one that is the property is being leased to. And that contract conveys the right, that is the lessor now is transferring the right to use an asset to the lessee for our considerations and for a period of time. That is how simple the definition is. Quickly, let's go. You don't need to know all these ones. You know what a contract is. A contract is a contract. The right to control the use of an identified asset. And then a lease term. When we talk about a lease term, we are talking about a non-cancelable period for which a lease contract has been established for the use of an underlying asset. That is what we call a lease term. And then lease payment simply means the consideration that you are paying. That is the that is the amount that the lessee is paying the lessor, for the use of that underlying asset over a period of time. Now, lease payment. Let's take down this note if you can hear me. Lease payment, they are payment made by a lessee to a lessor, conveying the right to use an underlying asset during a lease term. This lease payment can be broken down into three, as it were. Number one, lease payment can be, number one, a fixed payment. This fixed payment implies that this is the amount that you will be giving me every year when you are using these assets. Before I proceed, understand that a lease contract that is within 1 year will necessarily not need any form of accounting treatment other than you recognizing it as an operating lease in your statement of profit or loss account. What I'm trying to say is this: once a lease contract between a lessee and the lessor is for 1 year period, or the amount is immaterial, is very low, you will always treat that lease as an operating lease in your statement of profit or loss account. In other words, whatever you are giving to the lessor, you will treat it as an expense. Whatever you are giving to the lessor, you are treating it as an expense. But once the lease contract is above 1 year, 2 years and above, you are going to treat it as a finance lease. Please understand that very well. Period of time matters a lot. Amount involved, that is the amount that is involved that you are paying, also matters a lot. Once a lease contract is within 12 calendar months, you treat it as an operating lease. In other words, the amount you are paying the lessor as a lessee, you are going to carry it as an expense in your profit or loss account. But if the amount you are paying as a consideration is higher and the contract is above 2 years and above, you are going to recognize what we call a finance lease. A finance lease. Please understand that. Now, before now, we used to have treatment for operating lease and finance lease under IFRS17. They have cancelled all those treatments under IFRS17. What we now have is accounting for the lessee. If the contract is above 1 year or the amount involved is a very meager amount. That is that for that. We are talking about definition of terms. And we need to understand this definition of term before we proceed to anywhere. Because if we don't have the understanding of this definition, there will always be problem. Let me go back. What is a contract? A contract is what conveys the right to control the use of an identified asset when a customer have both the following. Number one, the right to obtain substantially all the economic benefit from the use of an identified asset. What this is simply saying is that when you, as an individual, you now have the right to substantially, use the asset to generate future economic benefit, like I've explained before, you have a contract. If the contract gives you the right to direct how the asset will be used, there is a contract. Now, understand this. If the contract do not give the lessee the right to control how the asset will be used, you can't call it a lease. If the contract do not give you the right to use the asset to generate future economic benefit, it cannot be called a lease contract. A good example is when you meet these people that are doing hire purchase, for instance. They give you a car. You deposit the document with them. You carry the car away. And what do? They will tell you that this total amount for this car is 500,000 naira. They are going to pay us 600,000 naira. They have already charged what we call interest on it. You are going to pay us back every year 100,000 for the next 6 years. They now give you the car. Once they give you the car, a contract has been established. The car, they don't have right over that car again. It is you that have right over the car. You can use it to go and do trading or whatever you want to use it for, and so that you can pay back their money. The people that gave you the car, they are known as the lessee. You that collected the car, you are known as the people that gave the car, they are known as the lessor. You that collected the car, you are known as the lessee. The amount you are paying back is known as a lease payment. And then the contract, the number of years is the lease term, the lease period. And that is the term that the contract is going to be before it elapses. I'm trying to just break this down in a seamless way so that you can have understanding of it. But I'm sure you do understand it, so that we won't waste more time on this definition. Let's just move ahead. That is that for that. Lease term is just a period. And then the lease payment is the amount that you pay. That is the consideration that you pay. And then this consideration can be divided into three. That was where I was before I went back to go and do some reviews on certain terms and conditions that you need to understand. So the lease payment is for, number one, can be fixed payment, less any incentives. This fixed payment means the amount that you, the lessor and the lessee, they have agreed that you will be paying. It is fixed. It does not change. That is one. B, we can have what we call variable lease payments. These variable lease payments, work with what we call rates. The variable lease payment, for instance, they may tell you that if if you meet certain conditions, for instance, now let me use this example. You enter a warehouse, enter a lease agreement with the owner. The owner of the warehouse, that is the lessor, now told the lessee that, okay, you are going to be paying me 100,000 naira every year. But whenever the goods you are packing in this store fill up the entire store, anytime you fill the entire store, that everywhere is filled up, you will be giving me 10% additional on the 100,000 that you are paying. That is what we call a variable lease payment. A variable lease payment is an addition to the fixed payment. Usually, that's how it used to be. Another example may be all these people that are into, I'm sure you know that most of these Mr. Biggs, Chicken Republic, most of the people that are running it, what they buy is the franchise. Some of them, it's not that they buy it, they lease the franchise. It's usually a lease contract between the owner of Mr. Biggs, Chicken Republic, and the likes. Now, once they give that franchise to those people to go and operate, it is a lease condition. Now, usually they will tell you, you are going to be paying us back 100,000 naira for this also number of year. But once you make sales of over 2 million naira, you are going to give us 2%. That is what we call variable lease payment. I hope you understand it. The third one is what we call the excess price of a purchase option, if the lessee is reasonably certain to exercise that option. This excess price simply means that at the end of the contract, option is available for the lessee to actually buy the property. That is another type of consideration. Then another type is what we call payment of penalties for terminating a lease contract. Payment of penalties for terminating a lease contract. So that is known as a penalty consideration, excise consideration, variable consideration, visible fixed consideration. So you can have this type of 4 types of lease payments. I'm trying to mention this now because there was this icon question that was set that they brought 3 out of these 4 out, and they use it to, it's not icon, it's an ACCA question. They use it to confuse the student. There is a fixed payment, fixed consideration. Payment is the same thing as when we talk about lease payment or consideration. They can be interwovenly used. This lease payment can come in four types. Number 1, fixed lease payment. This one is the one that you know that this is what you will pay. The lessor is expecting that you must pay. The lessee and the lessor that have agreed you are going to pay is a fixed payment. Variable lease payment. This one has to do with certain conditions. Certain conditions. If this thing happen, this is what you will pay. This is the addition that you will give to us. Then we have excise price lease payment. That is, it is like a purchase option. You are going to buy the property at the end of the lease contract. The lessee can choose the option to buy or not to buy. But once it is agreed that at the end of the lease contract you are going to buy it, you must exercise that option. And then the 4th type is penalty consideration. That is, when either of the party terminate the lease contract. It's as simple as that. I hope we are all following together tonight. If you can still hear me and if you are following me, if you understand it, please just give me a high five. Thank you. Okay. So please, let's go to another key thing that you need to know tonight, and that is what we call residual value. Residual value. Residual value is the usual residual value that you used to know. That is what will be the value at the end of a useful life of an asset. That is the simple literary meaning of a residual value. Now, under the lease contracts, it is expected that there will always be this residual value for the property that is involved. Usually, it happens like that there will always be this residual value. And that residual value can either be guaranteed by the lessee or not guaranteed by the lessee. Joy, you are raising your hand. Or mute and speak, please. Joy Williams. Are you there? Okay. Please, let's proceed. Like I said earlier, residual value means, what at the end of a useful life or at the end of a contract, as it were, and under this lease context that we are looking at now, at the end of the lease contract, the property is expected to have a value. Now, this residual value can either be guaranteed or not guaranteed by the lessee. In other words, we can have two types of residual value. We have two types of residual value. We have the guaranteed residual value and we have the unguaranteed residual value. Guaranteed residual value simply means implies that the lessee is guaranteeing the value of the assets at the end of the lease contract. Therefore, any shortfall from that value, the lessee is going to pay it. Now, let me come again. Guaranteed residual value. This is the value that the lessee guaranteed that will be in place at the expiration of the lease contract. And that when there is a shortfall or a deviation from that value, the lessee will pay for it. Let me use a very good example so that you will understand it. Let us assume that myself now and Wale, we enter into a lease contract. The lease contract is to, expire in 5 years' time. I valued the property I'm leasing to. Let's assume a building now. I value the building, and I said at the end of 5 years, this building should be 500,000 naira as a worth. Guaranteed residual value, that is the residual value, what I'm expecting that the worth of the asset will be at the expiration of the contract. Wale now agreed that, okay, I agreed. That is what the value of your building will be at the end of 5 years. Yes, I guaranteed. He now went further and said that if your building is not, if the worth of your building is not up to that 500,000 naira, whatever is the shortfall, I will pay. That is what we call guaranteed residual value. We can be asked to write a short note on this. That's why I'm taking my time now. Now, let us assume that at the end of the 5 years, the building was valued. And because Wale have misused my building, puncture it everywhere, nail, the ceiling has fallen off and the lights, I now value the building Instead of the building to be 500,000, the building is now 450,000. The difference between 450,000 and 500,000 is 50,000. That 50,000, Wale have already guaranteed that it will pay, and then it must surely pay. That is what we refer to as residual guaranteed residual value. And the other type of residual value is the one that is not guaranteed, which is known as unguaranteed residual value. And this is the one that the lessor do not guarantee. Whether your building fall in value or increase, does not concern me. That is the simple meaning. I hope you are following. Any question? Any question so far? Please, if you have a question, just raise your hand. And then, thank you. But can you hear me? Do you have understanding? Is everything going well with everybody? Oladozuzena, please ask your question. Unmute and ask your question.
Okay, good evening, sir. When you were talking about IFRS 16, this Lease, you said that lease is like for rent, like rent. Sorry, I don't know how to put this. Like they rent you rent a property out to get a consideration for it, right? So I want to ask what's the difference between this IAS 40 and IFRS 16? Like IAS 42 is investment, but I read sometimes ago that IAS 40 is like renting something out for capital acquisition, or like rent or capital acquisition. So I'm always getting confused that what's the difference between this lease and this IAS 40.
Thank you so much. Okay.
Thank you.
You can unmute, please. Now, the difference between IAS 40 and IFRS 16 is this. IAS 40 talks about an investment property. And an investment property simply means, Joy, I'm coming, please. An investment property simply means, a property, usually land or building or boat, that an entity is holding for rental purposes or for capital acquisition or both. Do you understand now? The difference between that property under IAS 40 and the one under IFRS 16 is this. Under IAS 40, the property still belongs to the owner. The owner still reserves the right to use that asset. The owner did not lose control of use. The right of use of that asset under IAS 40 investment property still resides with the owner. Whereas under IFRS 16, once the contract has been established, the lessor is transferring. That's why we say he conveys. The lessor has transferred the right to use that asset to the lessee for those period of time that they have agreed that that property will be with the lessee. I hope that is clear enough. Another thing again is this. When you don't have the right on how to direct how an asset will be used, or the future economic benefit from that asset is not coming to you, that item can no longer be referred to as an asset. You can no longer refer to it as an asset. And that is why renters under IAS 40 is going to the owner. Is that not so? Whereas under this lease arrangement, what you are paying is known as a lease payment. It's not a rent. It's a lease payment. That's what we call a consideration. So it's not a rent. So don't mix it up. It's not a rent. It's a consideration that you are paying. And then you are also paying interest on it, as it were. Zainab, I hope you are clear.
Yes, I am clear, sir. Thank you, sir.
Okay, so there are clear differences. Please don't mix them up. IAS 40 is different from IFRS 16. Renters, the rent that they collect under IAS 40 goes to the owner. Under IFRS 16, they are not paying rent. What they are paying is known as a lease payment or a consideration. Is that okay? It's like a contract between them. This is what you are going to pay me, and that is that for that. So let's proceed. Any other further questions? Any other question? So in the absence of any further question, let's go to the accounting treatment of this lease accounting. Before we move ahead, let's talk about the recognition. When we talk about recognition, I've always been telling you what are the certain criteria that must be met for you to classify certain items under the elements of financial statements. Recognition of a lease contract. For a lease contract to be recognized, or for a lease asset or liability to be recognized in this financial statement, the following criteria must be met. Number one, there must be a contract between the lessee and the lessor. That is number one. Number two, this contract must give rise to the lessor having the right to use this asset for a period of time. And number three, this right must give the lessee every available means to use this asset to generate future economic benefits. And number four, there must be a consideration that must be exchanged with the lessor. It's as simple as that. Please note what I have just said now. I've mentioned about 4 things. The criteria must be fully met before you can classify or recognize a lease contract on your financial statement. That is, for you to recognize what we call the lease asset or the lease liability, this criteria must be fully met. There must be a contract. This contract must convey the rights. And this right must bring about you, the lessee, being able to generate future economic benefit and direct the control and the use of that asset, as it were. And then there must be an exchange of a consideration. That is that for that. And so, understand also that we have what we call the initial recognition and then a subsequent recognition. The initial recognition is such that once a lease contract has been established, you must recognize what we call a lease asset and a lease liability. That is the initial recognition. And so that you will not confuse yourself, IFRS 16 have told us that instead of us calling it a lease asset, we should call it right of use assets. Why? Because the lessor is transferring the right to use that asset to the lessee. So you recognize it as a right of use assets. And then you have to recognize lease liability. Every lease contract will always give right to the right of use asset, an asset to the lessee, because of course he will not be in possession of using the asset over a period of time. And then it will also give rise to liability, that is a consideration that he or she is paying back to the lessor. That is that for that under recognition. Quickly, let's go to any question on recognition now. I hope it's well understood. Are we still together? Okay, Joy Williams, go ahead, please. Please unmute and speak.
Okay, good evening, sir.
Yes, go ahead, please.
Please, can you throw more light on the recognition of the lease
Okay. Please
and the
listen.
accounting treatment?
Before we get to accounting treatment, just listen to the recognition now. I said that for you to recognize a lease contract in your financial statement, certain criteria must be met. Number one, you must be able to establish that there is a contract between the lessor and the lessee. This contract must convey the right to use the assets, and that right must give the lessee, that context to be able to generate future economic benefit from the use of the assets, and then you must be able to direct the affairs of the assets, and as well pay what we call a lease consideration, which is also known as a lease payment. Once these items are within the scope, you can recognize what we call a lease contract on the financial statement. And then this lease contract will give rise to what we call the initial recognition of a lease asset and the lease liability. The lease asset is to be called right of use asset, and while you sustain the other one as a lease liability. It's as simple as that. Is it clear, Joy?
Yes, sir. Thank you, sir.
All right. Any other question? Okay, let's proceed now. Let's go to measurements. I told you when we talk about measurement, we are talking about how to calculate values that will be attached. We have agreed that we have what we call the right of use asset, which is also known as lease asset, and we have what we call the lease liability. Your lease liability and your lease asset will always be recognized under your assets and liabilities in your statement of financial position. What are the steps that we use to do the calculations? Step 1. Determine first the initial right of use assets, which is also known as lease assets. Step 1. That is, calculate the value of right of use assets. How do you calculate this? It is calculated as follows. The following items are what make up the right of use assets. Number 1, the lease liability. Number 2, every direct cost. You less incentives from it. Then you add back what we call cost of dismantling, removing and restating the asset back to its original state. So the composition of the right of use asset are as follows. Number 1, lease liability. This lease liability is the same thing as the lease payment. Lease payments are what we refer to as the future payments that is expected from the lessee to the lessor. To use a liability to the lessor is an income. You are the one paying it to the lessor, but to you is a liability. So for you to determine the cost, you must, be able to ascertain. For instance, now look at it this way. Me and Joy, we agree. I'm the lessee. She is the lessor. She told me that our building, I can use it for the next 5 years to do whatever I want to use it to be doing. I choose to use it to be producing ice cream. It does not concern Joy, whatever I want to use it to do. And I agree with Joy that I will be giving you 100,000 naira every year for the next 5 years that I'm going to use this building that she has given to me. That 100,000 naira is known as lease payments. Now understand this. For you to determine your lease liability, you know there are future cash flows that the estimated future cash flow. You have to consider what we call the time value of money with those future cash flow. In other words, all those lease payments, you know, me and Joy have agreed 100,000 I will be giving to Joy every year for the next 5 years. Those are future cash flows. Now, I need to discount those future cash flows into today's value because tomorrow itself is not certain. Anything can happen. Inflation can rise, interest rate can increase, anything can just happen. But I know today. So I will now discount the future value into today's value to get what I call the lease liability, the actual lease liability that I should carry in my book as at today. And why also are you doing that? So that the information you are presenting on the financial statement will be true and fair and faithfully represented. For those that want to use it, the people that want to use it to make decisions, they can use it to make a quality decision. That is number one. Number two, we have what we call direct cost. Once you're able to determine your lease liability, you have to hit what we call direct cost. Direct costs are the costs that you as an individual, you know, you expended in bringing, you know, the property or the asset, the underlying asset, into a portion that you can use it. I hope you understand what I'm saying now. Direct costs are the costs incurred by the lessee to make the asset usable, to make the asset, you know, utilizable. I'm just trying to use a layman language. I don't want to be using technical words so that you can understand this thing as a layman, and then, you know, you can interpret it technically as they want it. That is direct cost. What about asset? Direct cost less incentives. Incentives now, they are the amount that you receive from the lessor. Take for instance, the building between myself and Joy. Joy gave me the building that I should use. When I now went into the building, I saw that the building, we need to repaint it before I can use it. The amount of money I spend in painting it is known as a direct cost. As I was now painting, the Joy now came in as a lessor and said, "You are painting? Okay, let me give you 1 bucket of paint. I think the 1 bucket of paint is 20,000. Let me give you the 20,000. Go and buy a paint and use it and add it also that you can use to paint the place. That 20,000 will be deducted from the amount that me as a lessee is using to paint it, so that I can come by the actual cost that I use in painting the place. And that's what we call direct cost less incentives. There is another future cost, which is known as the cost of dismantling, the cost of restating the asset back to its original state. Take for instance, if the building that Joy rent to me now, I use it as an office, I now partition it. You know, partition 2 rooms into an office. I put 1 manager, I put another manager here. Definitely, I will tamper with the wall. I will have broken the wall or break a tie, or you understand. So all those costs of dismantling, removing, restating back the asset, I will have envisaged it. Okay, let's say in 5 years' time, when this contract is elapsing, I will spend 500,000 naira to bring back this asset to its original state. This 500,000 naira, the worth of it as of today, I need to know. And so therefore, you are going to discount that 500,000 naira into today's value. So there are two discounting that you are going to do for you to arrive at the right of use assets. It's as simple as that. Any question? So all this step one that we are talking about now is first you determine the lease liability, which is also the present value of the future cash flow, and then you have to hit initial direct costs. This is incurred by the lessee. You less incentives from it, and add all the cost of dismantling. So let's quickly look at an illustration. We have been talking too much. Let's look at an illustration, and I believe that will help our understanding. Let's look at this illustration one. Ganusi Nigeria Limited enters into a lease contract with Alpha PLC. The following information is relevant for references and considerations. I hope we are still together. Ganusi Limited must pay 5 annual rentals of 100,000 in arrears and in advance. Ganusi Limited must also guarantee the residual value of the asset at the end of the lease term to be 40,000 naira. Ganusi Limited incur initial direct cost of 5,000. The interest rate implicit in this lease is 8%. I'm being told that we have just few minutes left. Now, before we solve this question, there are certain things that I've seen now that I need to quickly discuss for your understanding. Number one, lease payment can be made in arrears. Lease payment can also be made in advance. Don't confuse yourself. Anytime you hear the word arrears, that a lease payment, that is the consideration you are paying, you make it in arrears. Understand that that lease payment was made or is made at the end of the year. The lease payment is made at the end of the year. And when you see that they said the lease payment or the lease rental or the annual rental is made in advance, is paid in advance, just know that that lease payment was made at the beginning of the year. Let me come again. Lease payment in advance simply means a lease payment that is made at the beginning of the year. Lease payment in arrears simply means a lease payment that is made at the end of the year. Now, for you to do the valuation, there is a little trick there. If you don't know it, you will not know it. What I'm saying is this. Once a lease payment is made in advance, it simply means that the lessee have already committed cash, has paid out cash to the lessor. Therefore, in your year one, when you are going to evaluate your right of use assets for the year one, your initial recognition of the right of use asset, when you are discounting the lease liability, you are going to discount for only 4 years. Why? Because you have made payment in advance, meaning you have made the payment is already made in what do we call it now? It has been made to the lessor. The lessor have already received cash for it, so you are not going to discount what you have already paid out. It is no longer referred to as a future. It's no longer referred to as a.
Sorry, sir. I think this call will end in 4 minutes, sir.
Yes, I'm aware. I'm
just a quick reminder.
I'm saying it. I'm just trying to give a little explanation. Then we create another link. We join and we will solve the questions. Yes.
Okay, sir.
Thank you. So, in arrears, if the lease payment is made in arrears, and the terms or the period under consideration is 5 years, it means that when you are valuing your lease liability, that is, if you are discounting your lease liability, you will discount it using 5 years. Now, let me just summarize it. If your lease payment is made in advance, you are going to discount those future cash flow in 4 years. Why? Because you have already paid the first leg in advance, you have already made that payment. That first payment that you made is no longer referred to as future cash flow that you are estimating. But if it is in arrears, that is, you are going to pay at the end of the year, it simply means that you are going to estimate for the next 5 years. That is one. Another thing I saw here is the interest rate that was given. You see, these people that are setting questions for you, they are very wicked. They are going to put it, sometimes they will put something like explicit rate, implicit rate. You will not know the one to use to do your valuation. Anytime you see explicit rate and implicit rate, always use implicit rates. Don't ever use explicit rates. Use implicit rate. Implicit rate simply means the rate that is specifically for your contract. Specifically for the contract that you have. Every rate is the general rate that is available. And then sometimes they may also tell you that please let's quickly create another link and then we can join and move on. Thank you.